at Accountancy Basics for Non-Finance Candidates, Part 1. About the trainer, I am Vijayalakshmi Balakrishnan and my core expertise is in SAP data migration, finance and controlling, business consolidation, business warehouse, and business planning and consolidation. I have around 25 years of experience, out of which the first 10 years pertains to domain experience and the last 15 years pertains to SAP implementation, support, and rollout projects. Each challenge is an opportunity. Make the best use of it. Change is the only word that doesn't change. Everything else changes. Best thing you can gift another human being is building their self-confidence. Don't fish for them. Teach them how to fish. The contents of this session is split into 3 parts, and we will be covering part 1. The contents of part 1 is as follows: objectives, introduction, bookkeeping, accounting, methods of accounting, meaning of debit and credit, types of accounts, and relevant rules. Part 2, a separate video, will cover accounting terminology, accounting equation, posting of journals, ledgers, trial balance, profit and loss account, and balance sheet. Part 3, another video, will cover the adjustment entries. Welcome to the world of accountancy. Topic 1, aims and objectives. The objective of the basics of accountancy sessions is as follows. Part 1 is to know the meaning, definition, and objective of bookkeeping, to study the objectives, function, importance, and limitations of accounting, to understand the methods of accounting, kinds of accounts, and accounting rules. Part 2 is to prepare simple journal entries, ledger accounts, trial balance, profit and loss account, and balance sheet statements. Part 3, to prepare profit and loss account and balance sheet statements with adjustment entries. Topic 2, introduction. In all activities, whether business activities or non-business activities, the main purpose is to record the incoming or outgoing cash flow, or anything that is equivalent to the value of cash. So in other words, wherever money is involved, accounting is required to account for it. Accounting is often called the language of business. The basic function of any language is to serve as a means of communication. Accounting also serves this function. Topic 3, bookkeeping. What is bookkeeping? Well, the meaning of bookkeeping includes recording of journal, posting in ledgers, and balancing of accounts. All the records before the preparation of trial balance is the whole subject matter of bookkeeping. Thus, bookkeeping may be defined as the science and art of recording transactions in money or money's worth so accurately and systematically in a certain set of books regularly that the true state of businessmen's affairs can be correctly ascertained. Here, it is important to note that only those transactions related to the business are recorded which are or which can be expressed in terms of money. Objectives of bookkeeping. The first objective of bookkeeping is to provide a permanent record of each transaction, and it also provides the soundness of the firm, and it can be accessed at any given point of time on a particular date to know the assets and liabilities of that business firm. Another objective of bookkeeping is to facilitate to know the profit or loss at a given period. It also enables to prepare a list of customers and suppliers to ascertain the amount to be received or to be paid. Bookkeeping gives opportunities to review the business policies in light of the past records. Amendment of business law, provision of licenses, assessment of tax, etc. are based on these records. If you have any questions in the topics covered so far, please leave them in the comments section and we will answer you as soon as possible. Let's go on to topic 4, accounting. The meaning of accounting. Accounting as an information system is the process of identifying, measuring, and communicating the economic information of an organization to its users who need the information for decision making. It identifies the transactions and the events of a specific entity. A transaction is an exchange in which each participant receives or sacrifices value. For example, purchase of raw material. On one hand, if it's a cash purchases, on one hand you give cash, and on the other hand you get the raw material. If it's a credit purchase, then on one hand you get the raw material, but you ask for time, probably like 3 months credit means you ask the time to pay the money within or at the end of the third month to the supplier. So that's a credit purchase. An event is happening of consequences to the entity. For example, use of raw materials for production. So the moment you buy raw material, the next event which happens is to use them in production. So this is the event of what happens next as a consequence. An entity means an economic unit that performs legally accepted economic activities. An entity or an organization is a legally formed, in the eyes of law, it is treated as a person. So it is bound by its activities and it has to obey the legal rules and regulations. Accounting Definition. So the American Institute of Certified Public Accountants, AICPA, which defines accounting as the art of recording, classifying, and summarizing in a significant manner and in terms of money, transactions, and events which are, in part at least, of a financial character, and interpreting the results thereof. So we've seen what a transaction is, we've seen what an event is, and its recording of all the events and transactions in order to derive whether the business is making profit or loss, and to derive the balance sheet, which gives a list of the assets and liabilities to find out the soundness of a business at any particular date. What are the objectives of accounting? The first and foremost objective of accounting is to keep a systematic record of all the transactions. The next one is to ascertain the results of the operation. So whether a particular event is yielding profit or loss, whether this business is making too much of expenditure over the income, or whether the income is in excess of the expenditure made or done for a particular period of time. To ascertain the financial position of the business. Now, whether the business has more assets than the liabilities, or whether the business has to owe more to outsiders when compared to the assets it's having. So in order to figure out the balance sheet, the soundness of the business, we use accounting. Accounting is also used to portray the liquidity position, how much of cash is readily available to spend, how much of assets, current assets, can be converted into liquid cash if there's an emergency or requirement of cash to be paid. The next objective is to protect the business properties. Accounting provides an up-to-date information about the various assets that the firm possesses and the liabilities the firm owes, so that nobody can claim a payment which is not due to them. Another objective is to facilitate rational decision making, where the accounting records will help the management to make decisions based on the events which has happened in the past. Accounting is also used to satisfy the requirements of law. So the entities such as companies, societies, public trusts are compulsorily required to maintain accounts as per law governing their operations. There are various acts like the Companies Act, Societies Act, Public Trust Act, and this also includes the Income Tax Act and the Sales Tax Act. Importance of accounting. Accounting is very important when it comes to the owners. They have to get the true picture of the value of money which they have invested, and accounting paves way to provide the true picture of the organization. the soundness of the business. And it also gives how the capital is being employed and whether it's properly being employed or not. So the owners can get an accurate picture of what their capital is being utilized and in which areas it's been invested into. The management uses accounting to facilitate in drawing future course of action, further expansion, etc., etc. Creditors use the accounting statements of a firm to whether to lend to the business or not based on their past performance. Employees rely on this data to know how much of profit is earned by the organization and whether they can expect hikes or bonuses or wage rises from the organization. Investors who want to invest their money in a firm, of course, wish to see the progress and prosperity of the firm before investing their amount by going through the financial statements of the firm. This is to safeguard the investment. For this, the group is eager to go through the accounting, which enables them to know the safety of their investment. The government is also interested in the accounting statements of an organization so that it can know the earnings for the purpose of taxation, and to comply to national accounting is essential. Consumers are interested in getting the goods at reduced prices. Therefore, they wish to know the establishment of a proper accounting control, which in return will reduce the cost of production. In turn, less price to be paid by the consumers. Research scholars rely on accounting information for determining the financial performance of the business organization. They also do a detailed study on the policies or strategies followed by the organization when it comes to purchases, sales, expenses, cost of material used, controlling the expenses, and investing in current assets, the strategies behind investing in fixed assets, and how the organization handles the current liabilities and long-term liabilities, shareholder funds, etc. Functions of accounting. Functions of accounting primarily involves the recording or record keeping of the transaction information. So, the transactions of an organization are posted as journals, and then ledgers, and the final statements are prepared. Thus, accounting performs historical function, which is the past performance of the business, and this facilitates decision-making program for future activities. Managerial function involves the decision-making program, and it is very difficult to make decisions in the organization without accounting. The day-to-day operations are compared with some predetermined standard which varies from one business to another. Hence, this is also a primary function of accounting. Legal requirement function. Auditing is compulsory in the case of registered firms, and proper audit is not possible without accounting. Thus, accounting becomes compulsory to comply with legal requirements. Accounting is a base, and with its help, various returns, documents, statements, etc. are prepared. Language of business. Accounting is the language of business. Various transactions are communicated through accounting. There are many parties, owners, creditors, government, employees, etc., who are interested in knowing the results of the firm, and this can be communicated only through accounting. The accounting shows a real and true position of the firm or the business. What are the advantages of accounting? Accounting provides a complete record of the business transactions. It also enables us to prepare the final accounts, like the profit and loss account and the balance sheet statement. It also helps the management to do an economic decision and a comparative study. It allows the organization to utilize enterprise resources effectively, and it also facilitates predicting, comparing, and evaluation of the enterprise earning power. It helps in complying with certain legal formalities like filing of income tax and sales tax returns. Limitations of accounting. It's historical in nature, so it dwells upon the transactions which has happened in the past, and it does not give a clear picture of non-monetary transactions like the effects of labor strike or reputation or employee morale. All these which cannot be measured accurately in terms of money does not find a place in accounting. And accounting conventions and personal judgments of accountants or management valuations vary from one organization to another. So it's not common, or it's not a standard practice followed amongst organizations. So because of this variation, we cannot compare two different companies' statements or strategies when it comes to accounting. Accounting statements do not always present comparable data, because within an organization itself, the strategy which they use for this year might differ from the strategies used in the previous year, or the strategy might be different in the future year. So within the organization itself, it's difficult to compare the data, and accounting statements do not show the impact of inflation or deflation. If you have any questions, please do post them in the comment section below, and we will answer them as soon as possible. Topic 5: Methods of accounting. So there are two different methods of accounting. One is the single entry method, and the other one is the double entry method. Single entry is a system which records only cash and personal accounts related details. It's an incomplete way of recording transactions, and other transactions are just ignored. So at any given point of time, only the cash related transactions and persons related transactions are available, whereas double entry is a twofold effect entry, and it is an accounting system that records the effects of transactions and other events in at least two accounts with equal debits and credits. So a double entry is a journal which has a debit or credit, or multiple debits and one credit, or one debit and multiple credits, or multiple debits and multiple credits, but the total of the debits should be equal to the total of the credits. Steps involved in double entry system. So first we prepare the journals. A journal has a debit entry and a credit entry. Then these journals are posted into ledgers, into grouping under the same heading. And these ledgers are balanced, and based on their debit balance or credit balance, they go into the trial balance. And from the trial balance, we can prepare the final accounts. The final accounts are the profit and loss account and balance sheet. Advantages of double entry system. It's a scientific way of recording things, and it's a complete record of a transaction, a debit and a credit, and it's an accurate way of recording transactions. You can ascertain the profit or loss because you have the complete information, and the knowledge of the financial position of the business can be derived because you have the assets and the liabilities, and any additions, deductions made to the assets and the liabilities are recorded as journals. Again, you have full details for the purpose of control. So it's not just recording the cash and the personal transactions, it's recording of all the transactions which happens in the business, which has a money value. You can do comparative study, it is possible, and it helps the management in making decisions, and there's no scope of fraud because each and every transaction is recorded in a proper way. If you have any questions, please do list it out in the comment section below, and we will answer as soon as possible. Topic 6. The meaning of debit and credit. The term debit is supposed to have derived from debitable and the term credit from creditable. For convenience, debit is denoted by DR and credit is used or denoted by CR. Recording of transaction requires a thorough understanding of the rules of debit and credit relating to accounts. Both debit and credit may represent either an increase or decrease depending on the nature of the account. If you have any questions, please do list them out in the comment section below, and we will answer them as soon as possible. Topic 7. Types of accounts and relevant rules. The objective of bookkeeping is to keep a complete record of all the transactions that take place in the business. And to achieve this objective, business transactions have been classified in 3 categories: transactions relating to persons, transactions relating to properties and assets, transactions relating to income and expenses. So, anything relating to persons is known as personal accounts. Anything relating to properties and assets is known as real accounts. And anything relating to income and expenses is known as nominal accounts. Now, in this diagram, accounts are split into personal and impersonal accounts. Under personal, we have natural, artificial, and groups. So natural is a natural person, like you, me, any person. A human being is a natural person. Artificial or legal is a company or an organization in the eyes of law is treated as a person. And groups or representatives are like societies or wages payable, all those salary payable. Salary is paid to individuals, but collectively it's known as a group. Salaries payable, wages payable, and all those stuff. So under impersonal, there's real account and nominal account. Real account deals with tangible and intangible assets. Nominal account deals with incomes, gains, expenses, and losses. So here we're giving examples of a personal account. A personal account is, when it comes to natural persons, it's like you, me, Kem's account, Lila's account, Sham's account. Both males and females are included in this. Artificial or legal persons, firms' accounts, limited companies' accounts, educational institutions' accounts, cooperative society accounts. These are all, in the eyes of law, are treated as a person, an artificial person. Groups and representative personal accounts are something like prepaid insurance, outstanding salaries, outstanding rent, outstanding wages. Though the wages are paid to individuals, collectively they're grouped under outstanding wages. Personal account. The rule for personal account is debit the receiver, credit the giver. So if I deposit cash into the business as a capital, then it would be, what's coming into the business? Cash. So cash account data, and credit the giver. So I'm the person giving the capital, so it's Vijay Lakshmi's capital account. Real accounts, debit what comes in, credit what goes out. So when it's tangible, real accounts deals with machinery, cash, furniture, stock accounts. Intangible real accounts deals with goodwill, patent, trademarks, copyright accounts. And the rule for real accounts is debit what comes in, credit what goes out. So in our example, cash is coming into the business by the way of capital. So debit what comes in, cash account data, and credit the giver to Vijay Lakshmi's capital account. So we're picking up one rule from the real account, the debit line, and one rule from the personal account, the credit line, and making it into a journal entry. So debit what comes in, cash account data, credit the giver to Vijayalakshmi's capital account. The third rule is the nominal account, where it says debit all expenses and losses, credit all incomes and gains. So wages account is an expense. Rent account is an expense. So suppose you're paying rent, then it's an expense, so debit it as per the nominal account. So rent account data. So how are you paying it? You might be paying it by cash. So what goes out? Cash is a real account, and credit what goes out. So rent account data to cash account. Suppose you're getting interest from a fixed deposit. So what's coming in? Cash is coming in. So cash account data, debit what comes in, and credit all incomes and gains. So to interest received account. So cash account data to interest received account. We will be seeing in detail of how to post a journal entry using these three principles. But before that, I would like to request you to memorize all these three rules. So debit the receiver, credit the giver. That's personal account. Real account, debit what comes in, credit what goes out. Nominal account, debit all expenses and losses, credit all incomes and gains. I want you to memorize these three rules because it's going to help us in going to our next session of posting journals. And no matter whichever course you do in accountancy, whether it be a chartered accountant course or ACCA or anything in any highest course in accountancy, the basics are these three rules. So please do memorize these three rules and then go to the second part of this session. Thank you. If you have any questions, please do post them in our comment section and we will answer you as soon as possible. If you like this video, please do click on the like button, and if you're a new user, new to our channel, please do subscribe so that you will receive notifications of the next upcoming videos. Thank you.